Hey, everybody. Dave Ramsey is wrong about life insurance, and I'm here to set the record straight, okay? His philosophies about life insurance are outdated and short sighted, and technically, he's wrong on a whole bunch of points. Dave's advice leaves people exposed to tremendous financial risks when they're older and can least afford it. Now, I understand Dave's trying to help the average guy get a good deal on life insurance, but you are not average. So his advice does not apply to you. He's setting people up for failure. Don't fall for it. All right, I want you to imagine this with me, if you will, okay? You go to your favorite clothing store and you're going to buy an expensive designer suit. You take it right off the rack, you rush home with it, and you're going to put it on and wear it to an event that night.
Wait, what? No, you can never do that. The suit will not fit.
That's right. Off the rack, it doesn't fit. I don't care how much money you pay for it, right? You got to alter the suit. You need a professional tailor that's going to come get the waist right, get the pant leg right, get your sleeves, the right size. It's got to be adjusted. Only after the professional tailor has customized that suit to fit you perfectly can you wear it.
That's right.
It's the same thing with life insurance, okay? You can't just pull it off the rack and expect it to fit and work the way you need it to. Remember this is really important. One size fits all financial advice doesn't fit anybody at all.
That's good. So, huddle up, team. We are John and Tara Thorman, your money coaches for entrepreneurs and small business owners, self-employed, and everyone who wants to be one.
Now, if you don't know, Dave Ramsey only recommends term life insurance 100% of the time, regardless of the situation or the facts or anything, okay? And he says that whole life insurance is a ripoff. Well, Dave, the world has changed. It's not 1970 anymore, and we'd really like you to catch up with the facts, okay? Now, you need to know this. Only 1% of term life insurance policies ever pay out a death benefit. And that's why I say Dave Ramsey is setting up 99% of people for failure.
Well,
They're designed to terminate, right? Term life insurance policies terminate after a period of time, or they renew at a much higher price. And so much so that as you age, get into your 60s and 70s, it becomes so cost prohibitive that people cancel the policies just because they can't afford it anymore, even though they still want and need the risk management protection that life insurance offers them. They simply can't afford it. So now they're terribly exposed because they have no more risk management from life insurance.
right.
Now, this is important. Remember, defense wins championships, and risk management is part of your defensive plays. And some of your risk management is life insurance. So your defense is going to be in shambles when you're old and can least afford it. You're going to get clobbered. So this leaves retirees at tremendous financial risk later in life. And how awful is that to think about having your risk management, having your life insurance, and paying premiums for 20, 30, or 40 years, and then having to wind up with none of it?
Well,
That sounds more like a ripoff to me. What about you?
right. For sure.
So here's 5 things that Dave Ramsey gets wrong about life insurance. And after that, I'm going to give you 2 things that you must make sure you have.
Right. In order to get it right.
That's it. Okay, here we go. Ready?
Number 1, Dave Ramsey says the only purpose of life insurance is to replace your income when you die.
Wrong. Okay, we need to understand that there's a whole bunch of purposes for modern life insurance, okay? It's not just for replacing income. That's just one of many reasons. So here's a couple other ones. Permanent life insurance is a flexible power tool. It's got many uses, especially for the entrepreneur, the business owner, and the self-employed. There is nothing that gives you the kind of leverage that you can get on your money like life insurance. Because for $1, you could get $1,000 or $10,000 worth of insurance benefits for you and your family. Also, permanent life insurance is used in the business world to fund all kinds of specific purposes, like funding your buy-sell agreements, setting up the funding for executive compensation or deferred compensation, also key man life insurance policies. If you look at it, banks and corporations buy all kinds of permanent life insurance to help ensure their executives and protect their business. Also, and don't forget this, with permanent life insurance policies, you can stuff those things full of cash and it acts as a backup savings account for your business.
Very good. All right, number 2, Dave Ramsey says that life insurance only pays out money to beneficiaries when you die.
Wrong. That's the old, outdated policies, right? That's ancient, prehistoric stuff. Those should have been called death insurance, right? Because those ones actually do only pay out when the insured dies. But the new modern policies don't work that way. So, modern permanent life insurance policies can include living benefits. Today, if you get the right policy, you can actually be a beneficiary on your own policy. The living benefits are powerful. It gives you access to the insurance amount if you have a heart attack or a stroke and you can't work. Now you can use that insurance benefit to replace your lost income. Okay? There's living benefits for critical illness, chronic illness, and terminal illness. Also, another living benefit of life insurance for you is the fact that it's building up savings account, is building up cash value, and you can access that anytime you want for any purpose. You can use it as leverage to help you buy investment properties or to reinvest in equipment and things for your business. Super powerful. It's not just death insurance anymore.
Right. And number 3, Dave Ramsey says you should never, ever, under any circumstance, you use life insurance as an investment vehicle.
Wrong. Okay, now this one's a little bit weird because it's a false comparison.
Right.
Life insurance is not like a typical stock or a mutual fund investment. It's not designed like that at all. It is, however, a very unique alternative asset class that, if designed properly, you can stuff it full of cash and build it up. So it's better to compare it to a savings account. We all have to save money. We all have to have savings account. So a savings account might make you 1% or 3%. A money market account might pay you 5%. Well, these properly designed life insurance policies can pay you 4, 5, 6, 7% return, and they're tax deferred, and you can get the money out tax exempt. Imagine not paying any taxes on the growth of your money over a long period of time. Super powerful. So don't compare it to a traditional equity investment because it's not. It's special and it's different, but you can actually get a higher rate of return than any bonds or bond funds without the volatility. There's no risk of losing any money inside these cash value life insurance policies if you get the right one and design it well. Get it tailored to fit you.
Oh, that's good. Number 4, he says that you won't need life insurance when you are retired because you're self-insured by your investments.
Wrong. All right. Here's the issue, right? There's no such thing as self-insured. Insurance is the transfer of risk to a large number of people. So you either have insurance or you don't have insurance. If you have life insurance, you're transferring the risk, and that's awesome. If you don't, what Ramsey's doing is saying you're setting yourself up so that there's only one person that's responsible if a catastrophic event happens, and now you got to spend all your assets. Imagine this. It's just like the analogy of you have a home and you have home insurance. So let's say the house is worth $1 million and you get it paid off. Well, do you give up your home insurance just because you paid off your house?
No.
Stupid, right? Why would you do that? The cost of the homeowner's insurance is insignificant to the value of the home.
Right.
Well, if their house burns to the ground and you're self-insured, that means you have to spend all your retirement money to rebuild your house. Now, what are you going to live on? That's crazy. So for most people, that is out of the realm of, reasonableness. And so what you're going to do is maintain the insurance protection. It acts now as nest egg insurance. You're protecting your nest egg because you don't want to risk having to spend all your retirement to rebuild the house. Same concept. Your nest egg insurance protects your retirement assets, okay? You need to have that financial security and protection. Don't expose yourself to that kind of catastrophic financial risk when you're retired, because you could never replace 40 years of savings, right? If there's that catastrophic event and you lose your retirement savings.
Right.
Don't set yourself up for that.
Number 5, Dave Ramsey says you need to buy long-term care insurance at age 60 because it's the best way to cover the sky-high cost of long-term care.
Wrong. Okay, buying long-term care insurance is not the best way. It's one way. And remember, there's always more than one way to do things. And we got to look at that option here when it comes to long-term care insurance, because you get the right kind of life insurance policy and it's got those living benefits, it'll replace the need for long-term care insurance. Now, just looking at this long-term care insurance that Dave recommends you get at age 60, super expensive, and you may not even qualify for it, right? And most people hate the idea of buying long-term care insurance because half the time you're just throwing your money out the window because you're never going to even use it. So don't be that wasteful with your money and expose yourself to that risk. Get the right kind of permanent life insurance with living benefits, have it your whole life, and you can use those living benefits to pay for the long-term care needs that you're going to run into. I think the best way to protect yourself, risk management, right? This is defense. Get the right kind of long-term care through the living benefits of your permanent life insurance policy.
Right, that makes sense. So, you know your birth date. Do you know your death date?
Yeah. And do you know what date you might experience a health crisis that'll disqualify you from buying any more insurance later? You don't, right? Now, here's why we ask that question. It matters. How can you possibly do good risk management if you don't know how long you're going to be healthy and playing the game? Right? Most people are way underestimating how long they're going to live, and we need to get this right so that we can plan accordingly. So consider this, for example. The 65-year-old couple today, odds are very good that one of them are going to live into their early 90s. So you need to be planning much longer than you think. It's not, retired 65 and be dead by 75 or 80. No, you could tack on another decade or decade and a half. We got to plan for this. That's why you want to have the risk management in place, that permanent life insurance that'll last you your whole lifetime. All right, so team, really quick. When was the last time you did a risk management assessment on your life, right? When did you last look and review your life insurance policies? You need to make sure you got the right kind, and then it's going to be there when you need it. So in the description box below, there's a link where you can sign up to get a free life insurance review from the coach, okay? And we'll make sure you got the right stuff in place, and it's going to be there when you need it. Now, let's get back to what is the better way to handle risk management and life insurance to handle many of the financial threats that you're going to experience in your lifetime. Number one, I recommend, suggest, encourage that you buy the right amount of life insurance. Get as much as you can to meet your family's needs as soon as you can. You don't want to wait on this. You don't know what the future holds. And it's not about, being alive or dead or not. It's about even just being able to qualify to get the coverage. I mean, we experience health situations. If you get cancer, you get a heart attack, you have some major, medical issue, you're not going to qualify for a good life insurance rate or enough coverage. It's like your home insurance. Again, you can't buy home insurance right after your house burns to the ground. You got to buy it way ahead of that, right? Same thing with life insurance. Buy it ahead of any potential future trouble so that you have it when you need it. So get the right amount of coverage or a little bit more as soon as possible, okay? Point number two, which life insurance is right for you then? Well, I think this comes down largely to your cash flow. Are you able to save a lot of extra money every month or not? If you can, if you do have overflows, right, lots of savings, then you can get permanent life insurance now and fill that thing full of cash. But remember, you can always do both. You can get term insurance and permanent insurance, do both, do a combination, and you can keep adding more as you go along. But the idea is, can you save more money and can you do it consistently? If you can, get a permanent policy, but don't just take it off the shelf. You got to tailor it so that you can maximize the amount of cash you put into that policy and minimize the insurance expense. And you want to do that because of the powerful savings features of those policies. Remember, the money grows tax deferred. You can access it tax exempt and get that money anytime you want, really fast and easy. I want to encourage you to consider it as your opportunity fund, right? You got your peace of mind account in one place over here, maybe at a bank and a high yield savings account. You got at least 3 months of liquid money there. Then you can start building up your opportunity fund inside the cash account in your insurance policy, because then you can access it whenever a great opportunity or an investment comes up. Take it out and put it back, take it out and put it back, but use it as a powerful wealth building tool. Now, if you're not able to save very much money right now, then don't buy a permanent policy. It's not the right time. But get as much term insurance as you can that's affordable. But I've got 2 conditions for you that must be met in order to buy that term life insurance. Number one, only buy term life insurance that comes with living benefits. Those are way too important for you. Remember, you want to be a beneficiary on your own policy while you're alive, okay? Most term life insurance won't have them. Avoid those policies, but the best term policies will have them. The second condition that must be met when you're going to buy term life insurance is it has to be convertible to a permanent policy. Okay, this is non-negotiable. You want to give that option and that flexibility for some point in the future, but you lock in your great health conditions now. But guys, this way, by getting the term insurance when you're young and healthy, you guarantee yourself future insurance protection, regardless of what happens over the next 10, 20, or 30 years. That's invaluable to you, and we got to plan ahead. Take advantage of that tip right there and get the most coverage for the least amount of money. Start saving, and then when you're good at saving and you've got the extra cash flow, then convert some of it to a permanent policy or buy another policy that's permanent and start stuffing that thing full of cash. So, in summary, most term insurance is a trap, okay? It's a trap because the policy terminates and it leaves you exposed when you don't want to be, or it gets so expensive that you end up canceling it. That's why only about 1% of term policies ever pay a death benefit, which is what they're designed to do.
Right.
Well, that's terrible. You're going to have great financial risks that you have to manage through your whole life, not just before retirement, but especially after retirement. And even after you die, there's financial risks for your heirs. And you can manage that best with a permanent policy. If you have the cash flows to support buying a permanent policy, you want to minimize the death benefit and maximize the savings element, okay? Put as much into that as the government will allow you. The government put restrictions on it because these are so good for you to accumulate money, okay? And as Ed Slott says, Ed Slott is a CPA, not an insurance salesman. He's a CPA, and he's coined as the America's IRA expert. And what he says is the tax exemption for life insurance is the single biggest benefit in the tax code. Make it part of your retirement savings plan. So let's listen to Ed on this, okay, and get this set up for you as soon as you can. You aren't the average guy or gal, so don't follow Dave Ramsey's advice on life insurance. The guy's just wrong, and he's setting 99% of people up for failure. Don't let it be you.
We'd love to read your comments, so drop them in the section below and crush the like button, share, and subscribe to our channel if you haven't yet. We don't want you to miss a single training session.
That's right, guys. Money and wealth is a team sport, okay? We want you to join the team here and play to win your money game. We want to coach you so you can achieve success faster, so you can enjoy it longer. All right? See you on the next video.